For the average person, what should they be putting their money into with everything you see happening in the world?
Yeah.
You said not Bitcoin, but where should we put it?
I'm an advocate of investing in broad-based, low-cost stock index funds.
What is that?
That is, an example of that is VTSAX, which is Vanguard's total stock market index fund. It invests in virtually every publicly traded company in the United States of America. The number of those varies, but it's roughly 3,600 companies.
So you're basically investing in America.
There are a lot of private companies that I'm not invested in, but I'm in every publicly traded company in the country. And that means everybody from the factory floor to the CEO is working to make me richer. Now, some of those companies are going to do extraordinarily well, and they're going to succeed dramatically. And because this fund, as most funds like it is cap weighted, and I'll explain that in a minute, the more successful the company is, the more of it I will own. So cap weighted simply means that the larger the market capitalization of the company is.
The valuation.
The valuation, right? The market capital, the larger that is, the greater the percentage of the fund it will represent. So you may have heard people say that the top 10 companies in the S&P 500 have an outsized representation percentage-wise of what that's the reason it's cap-weighted. So I benefit from that success, right? Now, if one of those companies falters and starts failing on their execution, or a more aggressive, better organized competitor comes along and displaces them, then they will drift away. But I'm okay with that because whatever that new competitor is, I don't have to predict who it is. I will own them. And that's a process that I refer to as self-cleansing. I'm very proud of that term that I coined. So a great example of that is Sears. When I was a kid, Sears, company you may not even be aware of, but Sears was the Walmart and Amazon of its time combined. But Sears, at the turn of the last century, the turn of the 1800s, looked around and said, we have these brick and mortar stores, but there are all these people living out in rural areas who are never going to get to our brick and mortar stores. We could send them catalogs. Does this begin to sound familiar? And then they could send us letters and money ordering things from our catalog that we could then ship to them. So they became, Walmart with the brick and mortar stores, and then Amazon of its time, absolutely dominated for 100 years. If you had said to somebody when I was first investing in the 1970s that Sears built the biggest building on the planet back in the 70s, what was then known as the Sears Tower in Chicago. If you had said Sears, its days are numbered, you would have been laughed at. But its days were numbered because leaner, more aggressive competitors came along and ate its lunch. Nobody could have predicted that, certainly not me, but I didn't have to if I owned the index, because then when Walmart came along and then later Amazon and Sears faded away, I own those as well. That's that self-cleansing process.
And just for anyone that really doesn't understand this at all, you're not actually having to do anything because that index fund is just automatically making the decisions.
Exactly. I don't have to do anything. I just have to own it, and I can own it forever. So if I went and I bought Sears stock, as an example, back in the day, well, whenever you own an individual stock, you're going to be thinking about, okay, how long am I going to own this? And what is going to trigger my sale of this particular asset? And what has to happen to it that would make me not want to own it anymore? And then if I want to get rid of it and I want something in the same space, what do I buy? Do I buy this new upstart Walmart? Do I buy this Amazon that back in the 90s is run by this wacko guy, Jeff Bezos, who kept saying, no, profits don't matter, profits don't matter. Who invests in a CEO that says profits don't matter? That's nuts. Right? But those are the kinds of things you have to be thinking about if you own individual stocks. I don't have to think about any of that, owning the index. Because if Jeff Bezos turns out that his wackiness is brilliance, which it turns out it was, then he's going to rise to the top, which it turns out Amazon did, and I benefited from that. If it turns out it was just wackiness, it would have just faded away, as a lot of companies have. But that wouldn't have mattered because whatever succeeds, I will own and benefit from.
I was asking the research team beforehand, in the last 10 years, which index fund has performed the very, very best? And it said that the NASDAQ 100, which is very tech heavy,
Right.
has performed at almost 20% a year for the last 10 years.
Right.
And when I think about what's going on in the world at the moment and the advent of this new technology called AI, which is driving everything, it seems, and our lives are going to become way more technological with robots and automation and full self-driving, it appears to me like if there was ever a great time to be investing in an index fund, one should aim at the very tech-heavy index funds like the NASDAQ 100. Is that logical thinking, or is that?
It's logical thinking. Yes. So first of all, it's logical thinking. And actually, had you done that same analysis 10 years ago, you would have done better than VTSAX, right? Because technology has absolutely dominated for the last 10 years. It is a reasonable speculation that will continue into the future.
So why don't you
for some
invest in it?
period of time? Well, because the truth is that technology has not always dominated.
We're not going to go backwards, though, are we?
Well, no, but the point is that it changes. So just like in my Sears example, Sears would have been at the top of the index for a long time, and then it drifted away and got replaced. So that's an individual stock. Sectors of stocks have also done that over time, right? So right now, the dominant sector is tech. Wasn't always the case. Might not always be the case in the future. I don't know because I can't see the future. I understand people who would say that clearly that's the best bet, to go with tech. And your crystal ball is clearer than mine, and you might very well be right. But I don't have a crystal ball. And I don't have to worry about that owning the total stock market, because if you're right, I will still benefit very nicely. Thank you very much. If you're wrong, whatever replaces it, I will own.
So you have an analogy you came up with that involves beer and a glass.
Right. Probably came up with a drinking beer, but go ahead.
Well, show me the analogy.
So thanks for not. Whoa.
Oh, here we go.
I was going to say, thanks for not shaking up the can. So beer, right? So I'm pouring it right down the middle so we get a nice thick head. That's even a little thicker than I hoped for. Okay. So imagine for a second, right now we have a glass and we can see exactly how much foam there is and how much actual beer there is, right? But imagine this was that I poured it into this vessel instead, where we couldn't see that. The analogy is the stock market. So when most people think of the stock market, and when most people turn on CNBC, they turn on, they look at the investment news and what have you. It's all this churning and trading, what stocks are hot now, what stocks are rising, what stocks are falling, it's all this trading. That's not the simple path to wealth. That's the foam, right? So the value in a stock, whatever the stock is, what makes up the price of that stock is a combination of two things. It is the beer and it is the foam. And the problem is, unlike that glass, it's in a vessel like this. So it's hard to see exactly how much beer there is as opposed to how much foam there is.
And the beer is the value, the foam is the speculation.
Exactly. The beer is the fundamental operating value of the company, right? The sales and the expenses and the money that's left over that you call profits, right?
Yeah.
So that's the beer. The foam is what the market determines that's worth at any given moment based on emotion.
And
hype and speculation and fear and greed.
And so up here
Right.
is the total value of the stock.
Right, exactly. The total value of the stock. But this is all foam that can come and go very quickly, right? So think about Tesla, for example, right? Tesla has a lot of foam because a lot of people are speculating about the great things Tesla's going to do in the future. robotic cars, humanoid robots, all these kinds of things, which very may well come to pass. I mean, Elon Musk is a stunningly brilliant guy, so who knows? But that's the speculation. That's the foam. The underlying beer of Tesla, the actual operating company, does not justify the price of the stock. I mean, the PE ratio of Tesla, you can look it up, is some huge number, right? So there's a lot of speculation, a lot of foam in Tesla. Now, if things go to plan, then that foam will become, as in our example, you notice the foam is dissipating, we're getting more and more beer. If things go to plan for Tesla, that's what will happen. The foam will eventually settle out into more and more beer, and Tesla will justify that high price and maybe then some.
And I guess Warren Buffett's greatness, if I've interpreted his writing correctly, and why he was often considered as the greatest investor of all time, was he was able to pay for stocks where it was mainly beer, and he paid at the price of the beer, not for the foam.
Or he looked for times where the sentiment was so negative that he was actually paying a little less than the price of the beer. Benjamin Graham, who wrote The Intelligent Investor, who was a mentor to Warren Buffett, basically said what you should do is look for value companies and try to determine where the beer is, and then try to see if you can get a buying opportunity, watch it where you can buy it for less than the actual value of the operation. That's ideal. And in those days, when there wasn't so much information freely available, that was probably a little easier to do. Well, Warren Buffett has said since then, and that's a great foundation if you're going to pick individual stocks. But what Warren Buffett has said since then is he learned, and I think, and you don't quote me on this, but I think it was Charlie Munger who actually made this point to him, that it's going to be very, very hard in this day and age, even when they started back in the 60s, to find companies where you can actually buy it for less than the actual beer value. So don't try to do that. Just try to find companies that you can pay a fair price for that have a lot of beer in the mix, that are mostly beer. Because if you buy those companies, they are, by definition, very well-run companies, strong brands, big moats around them, which makes them hard to compete
I guess
with.
To do this, you're going to have a framework for valuing a company.
Exactly. And you're going to have great discipline.
Which is hard.
And that's what, as Warren Buffett said, I was blessed with an ability to allocate capital effectively. And that's basically what he has done. He has capital, and he has got the ability to look at different companies and say, of all the different companies I could allocate capital to, he's pretty skilled at picking the ones that are the best bets.
One of the things that I really admired about Warren Buffett was his ability to do nothing.
Which is one of the key things, because that goes back to Charlie Munger's thing, don't get in the way of your compounding, right?
And there has been recent times where I think we can all think of where, using your beer analogy, something happens in the world and the true value of a company is higher than the selling price. I.e., if you go back to March 2020 during the market sell-off when the pandemic happened and everybody panicked, Amazon, for example, the stock briefly dropped below, roughly to about $1,500 per share, well below its intrinsic value because people were panicking.
Right.
And then it quickly rebounded again past $3,000 a share. So theoretically, if you had noticed that drop, you could have made a 100% return on your money.
And by the extension, the whole market did that.
The whole market dropped, yeah.
Right.
Yeah.
So you could have done that with your index fund. This is why if you panicked and sold,
you're screwed.
Let's say you owned Amazon or you owned VTSAX and you panicked and sold, well, you would have lost everything, and then it recovered. So it works both ways. That's why I said earlier in our conversation, you have to stay invested so that the dip doesn't matter. And if anything, take advantage of the dip and buy more. So you own Amazon, you see it dip, you say, well, I still believe in the company. I still think it's a good company and it's got a good future. Well, then maybe you buy some more in the dip and you do still better. But the important thing is you don't sell when it's down because there's panic in the air.
And I think this speaks to a broader sentiment throughout this conversation, which is to do what others don't do. And Warren Buffett's famous for saying, be fearful when others are greedy and greedy when others are fearful. But generally, the sentiment on social media, especially for younger generations and especially for men, which is supported by the data, is that the way to make money is by trading crypto or by, there's so many people that sell, this is we need to address this.
It's a platform.
It's like gambling. It's just gambling.
Yeah, it's a gambling platform. And so that's going, people sometimes say to me, I never invest in the stock market. It's just gambling. I say, well, you're half right. Our foam is all dissipated. But if there was still foam here, I would say, yes, if you're doing it short term and you're playing with the foam, absolutely is no different than going to Las Vegas. If you're investing for the beer, it's an entirely different story, and you're investing for the long term.
And there's lots of young people that are being tempted into buying a course that's going to help them learn how to trade.
That's great for the people selling the course.
There's such an incredible, obvious irony to the idea that I have some secret about trading that's really going to make, that is capable of making one wealthy.
Right.
And I'm going to give it to you.
Or even sell it to you.
Why would I need to if it worked?
Right.
This is such an obvious question to me. Why would I need to sell it if it worked?
It is the obvious question.
And I feel sorry. I have great empathy because the people that buy these things are people that are desperate to get out of their financial situation and they've run out of options. And so it's very compelling to hear that there's some secret that you can predict the stock market. It's very compelling.
In another interview, I said one time we were talking about the same line of conversation we're having. And I said, I blame my mother. I would be a lot richer if she hadn't instilled a conscience in me. She's cost me millions of dollars instilling this conscience. I could have courses, I could be, but no. I am saying that there is a path that will give you great results. And it's a pretty well proven path at this point.
So many of us are pursuing passive forms of income and to build side businesses in order to help us cover our bills. And that opportunity is here with our sponsor, Stan, a business that I co-own. It is the platform that can help you take full advantage of your own financial situation. Stan enables you to work for yourself. It makes selling digital products, courses, memberships, and more simple products more scalable and easier to do. You can turn your ideas into income and get the support to grow whatever you're building. And we've just launched Dare to Dream. It's for those who are ready to make the shift from thinking to building, from planning to actually doing the thing. It's about seeing that dream in your head and knowing exactly what it takes to bring it to life. Enter to win $100,000 for your dream. All you have to do is share what it is. Learn more at daretodream.stan.store. This is something that I've made for you. I realize that the Diary of a CEO audience are strivers, whether it's in business or health. We all have big goals that we want to accomplish. And one of the things I've learned is that when you aim at the big, big, big goal, it can feel incredibly psychologically uncomfortable because it's kind of like being stood at the foot of Mount Everest and looking upwards. The way to accomplish your goals is by breaking them down into tiny, small steps. And we call this in our team the 1%. And actually, this philosophy is highly responsible for much of our success here. So what we've done so that you at home can accomplish any big goal that you have is we've made these 1% diaries, and we released these last year and they all sold out. So I asked my team over and over again to bring the diaries back, but also to introduce some new colors and to make some minor tweaks to the diary. So now we have a better range for you. So if you have a big goal in mind and you need a framework and a process and some motivation, then I highly recommend you get one of these diaries before they all sell out once again. And you can get yours now at thediary.com, where you can get 20% off our Black Friday bundle. And if you want the link is in the description below.